KB Homes down $5. Weak guidance. China fires a test missile. Pacific Ocean. Unstable geopolitics. Who cares? We're right at all-time highs here, folks, on the verge of another major breakout. We'll cover earnings. A lot of analyst calls this morning. Special guest, 8:35, Kevin Merritt, CFA, head of equity research at Wedbush Securities. Y'all gonna like him. It is Wednesday on PreMarket Prep.
Welcome to Benzinga's PreMarket Prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
Okay, folks, here we go. We're just a couple handles in the red here, just 10 handles below that all-time high, just a whisker away. Buck, that's up marginally at 10022. TLT, double bottom, maybe under 98, but still down 30 cents at 98.35. Crude giving some back after that $10 rally, down to $1.38 is 70.16. Gold, we're headed for 2,700, up 540, 26.8250. Silver, the catch-up trade here, down 19 cents at 32.34, but over $32 for the first time since early 2021. Bitcoin, it's down marginally, $620 at 63,840. Let's bring in AB Triple D simultaneously. And Dennis, how you feeling this morning?
I've got a cold, so I'm fighting the cold. Feeling grumpy, grouchy day. When you're not feeling good, and then it always snowballs. So I'm getting hit in my overnight portfolio there too. I had a little bit of China in there, and that's getting dinged pretty hard. So kind of miserable today. How are you?
I'm doing great. I'm doing absolutely
I like
fantastic.
It
Yeah, I'm still like this is still the middle of the afternoon for me. I'm still adjusting. Actually got to the gym at 5:10 today.
What time have you been going? What time have you been going to bed, Joel?
I've been going to bed at I kind of crashing on the couch at 9:30, going upstairs around 10. But it's just I'm just wide-eyed and bushy-tailed at 4 in the morning. I'm like, let's go. I got to do something.
Get up and trade. Trade those 4 a.m. opens. There's all kinds of money there. I just can't wake up to do it.
You might have permanently reset your what is it called? Your circadian rhythm or whatever it is.
Oh, that's an SAT word.
Yeah, that's a big word there. That's above my pay grade.
That's that Missouri journalist grad degree speaking there. But where do you guys want to start?
Let's start with earnings. Let's start with KB Homes earnings report, which came out after the close yesterday. KB Homes reported an EPS of $2.04, which missed the estimates by 2 cents. Revenue of $1.75 billion, beat by $20 million. The commentary was they basically said that orders were flat from a year ago. We know that's not what the market likes. Market doesn't like flat. They want growth. The stock slipped about $5, 6% on the news or on the report. And that's where we're trading at this morning, right at $82. But so not a great report, but the reaction, I would say a little bit muted here, only down $5.
I think it's just, again, it's the Lennar all over again. The bar is really high here, and the earnings were fine, but they expect the home builders every single quarter to just absolutely blow it away. And, Lennar kind of did, but didn't matter anyways. They knocked it down. KB Home, same story here. They've just been running. Interest rates coming down. You think it's going to be good for them, and it probably will be. And they just continue to, all the home builders continue to do really well. They make a lot of money. I build homes. I know what it's like. They just mark up everything. They do really well. So it's hard to be bearish these longer term. Dip probably gets bought. I don't know if it gets bought today, but eventually it probably gets bought.
I'd be interested to. Oh, sorry. Go ahead, Joel.
Oh, go ahead.
I was just gonna say, without the, we know the Fed now is easing, cut rates by half a percent, and planning on cutting more, which is good for home builders. I mean, when you can borrow money more easily, you can build more homes. Obviously, the lower interest rates also leads to lower mortgage rates, which should increase demand for housing. So, all that is good for home builders. I'd wonder if this would be trading down more if investors weren't aware of this happening on the back end, where it's like, yeah, that last quarter wasn't good, but moving forward, they might start building more homes. So like that could help explain, why after the report, it's not, I guess, Dennis, you said it was a good report, but the bar was high. So
I think so.
So maybe it's, I don't know.
I think the report was fine.
Super curveball here. Just looking at the technicals here, I'll just give you the pre-market low. Pre-market low 8103. Nothing there on the dailies. Your next daily low comes in at 80 and a quarter. So I'll just see how they treated the Lennar. I mean, they're two totally different stocks and had different patterns going in. I did LEN. So they did buy the dip in that. We'll see if they do the same in the KBH. But the thing just made a new all-time high yesterday. Lennar traders, have your head on a swivel here at 186. That's a double top from the last two sessions.
We've had Duncan Dave requesting VST for like 3 days here, and we've ignored it. Not that we wanted to ignore it. We just had other things to talk about here. But he's come out swinging here again. He wants to talk Vistra. I will tell you the Vistra and the CEG story is an AI story. We talked about these stocks a while ago. I talk about CEG quite a bit. They got the deal with Microsoft, CEG, and this was when you were away, Joel, I believe. And this stock has just not looked back. I mean, it just dipped a little bit, maybe cooling off a little bit yesterday, but it's went from 200 to 260 just like that. VST did not get the deal with Microsoft, but it didn't even matter. I think on a percentage basis, it ripped just as much, if not even more. It seems to be the strongest one out of the two, CEG and VST, but this is, energy. And if we're going AI and we're going to go bots, we're going to need a lot of energy, and VST and CAG are going to lead the way here, apparently. Now, chasing these things at this point in time is difficult. VST, it was $20 a year and a half ago. It's $112 now. I mean, it's like NVIDIA. It's the same thing. You're buying Vistra, it's like buying NVIDIA. You think we're blasting off and continuing to go. And the only thing is NVIDIA is consolidated here and starting to look actually pretty good, where Vistra's been running and running. I think you need a pullback now to get in these things. And these things do give you pullbacks. I mean, the VST had a significant pullback, just looking back at the charts, just back in August, when we went from $100 down to $66. That was the buying opportunity. Now, if you're coming in, you're definitely chasing it.
Boy, I think with Duncan Dave, he's probably getting a little nervous. He's probably long for some great level, and he's like he wants to hit that sell button, but he's not doing that. So what I'll say is, man, you can always keep an eye on the highest low it ever made, and that's a 111.18. If it loses that, I don't see any. Your next daily low is 107. So if you're not trying to pick a top, you also could do your Fibonacci extensions or whatever, your 116%. I don't even know what the hell they are, but I read about it. You could do that. You could look at the average daily range. But the two most important things to me are the highest low that it ever made and the highest close that it ever made. And both of those were yesterday. 111.18 at all-time closing high, 112.40. And if you want to talk about winning streaks, this thing has been up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row. So eventually, someday, one day, in
10
the near
days
future,
in a row. 10 days in a row it's been up.
Yep.
Wow. I mean, we've seen action like this before where they go up 10 days in a row and then they could go down 10 days in a row. Berk.B, 9 days in a row up, then 9 days in a row down. So just be careful, because we're still in this environment where chasers, seems to work for a day or two, or 9 days in this case, but chasers just haven't been rewarded. It's a choppy, random market. Yes, SPY is at all-time highs. Yes, the Dow is at all-time highs, and that's exciting and all. But it's been a lot of chop. This has been a very, very choppy month. I was saying to Joel and Aaron just on the pre-market show, it's been a lot of random moves, and it's been a tricky market to trade. This has been one of my crappier trading months, even though my long-term investment portfolio is killing it right now, because it's got obviously Tesla, AVAV, a lot of stuff. That portfolio is doing awesome, setting up at all-time highs too. But my trading account has just been chopping around. Like, usually it's pretty consistent where I can make money most days, but it's like I'm making money and then I'm getting hit. And then I'm making money and then I'm getting hit. And it's just in the last couple of weeks, the last 2-3 weeks, that I'm seeing that inconsistency here in my trading account, which is rare for me. And that's just because there's so many random moves. Like I come in and I'm getting beat on stuff. Like I was short Caterpillar yesterday. Goes up $17. Caterpillar, just out of nowhere.
Yeah,
Trump,
wow.
they're saying Trump commentary, a little bit of China, but he talked about deer, and then he didn't mention cat, but it's 17 points. I mean, this is not an earnings. It wasn't even on earnings. It's just up 17. I mean, some of the moves are really violent, and this might be a good segue into some violent moves last night. Check out Amgen. So, and AB will give us the headlines here, but Amgen had some wicked moves. I'm long Amgen in the long-term portfolio. Ooh. I did a little bit of trading on it last night, but it comes out with a headline. Meeting the primary endpoint, which is usually good news, but not in this case, AB. What was the headline?
Well, we had kind of an interesting love triangle, if you will, going on in the biotech space with Amgen and a couple other stocks. So you had one stock, or you had one drug, Uplinza, for Amgen, and it got a court ruling. Or sorry, that was for Ilera. Sorry, this is a little bit confusing, but basically you had Regeneron, which traded up on news that Amgen's drug got this. Wait, hold on. Am I mixing it up real quick?
It's tough, man. I'm gonna let you guys.
Confusing. I was so confused last night.
I'm sitting this one out.
So Regeneron dives as Amgen tees up its rival to money-making machine Eylea. So there's two different stories here. So one drug, a judge ruled that Amgen could make this drug that is similar to Regeneron's drug Eylea. So Regeneron has this drug. A judge was going to rule, or the market was thinking that the judge was going to rule that Amgen couldn't produce the similar drug. The judge didn't rule that, so now Amgen can produce this drug. And then there is a separate headline that you mentioned about its Uplinza drug, which it got good data, but not as good as for
ARGX, which is a competing drug.
Exactly. So ARGX went up on this data from Amgen, and then Regeneron went down because Amgen could make this drug that Regeneron also makes. So
I'm just going to recap because it kind of didn't go. It was close, but it kind of didn't go exactly like that. AB.
Okay.
And, I'll just recap.
Biotech's not my forte.
Oil's getting hammered right now. I'm just getting felt. This is just the kind of market we're in. Like if you're not paying attention or trying to do a live show and you got orders floating out there, you get hammered. Wow. No idea. Anyways, oil's getting hit here right now. I guess when you throw, missiles over the Pacific, that's bad for oil apparently. Makes a hell of a lot of sense, this market. This is the non-logical market though. Just, going to say that right now. But going back to the love triangle here, move away from oil. We'll come to that in a second. Amgen gets hit on that headline last night, I guess because the efficacy wasn't as good as ARGX or something like that, even though they met the primary endpoint.
Yep.
Stock goes down $20 last night. Bring up the Amgen chart, Joel. It goes down $20 last night. Then it rallies the whole damn thing back. Then it sells off $10. Then this morning it rallies it all back. This is the market where I'm talking about the random. It's like bang, 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 bang. That's what it did last night and this morning. So Regeneron, which has, the other drug or whatever competing, it goes up $55 last night out of nowhere. Just up 55. Like we go from 1045 to 1100 when Amgen was tanking. Then Amgen starts to rally, so then they got to sell Regeneron off. So the algos just turn around. No, we were buying 1100. Now we got to sell it because Amgen's going back up. So they sell Regeneron all the way back down, and Regeneron looks like it's doing nothing now. It was up 55 points last night. Bid up there, 1100. Have at it. You can hit the bid, 1100. It's just, this kind of market. And the ARGX was down originally on the Amgen data. Now it's up. So, reversals and no follow through and, just random moves. That is just so typical of this market here on an individual stock basis. It's just been a really, really tricky market where, some markets it's like, oh, we're trending. Some markets, oh, you're buying the dip or you're selling the rips. This is just buy dips and sell rips all over the place. If you were doing that on Regeneron Amgen last night, you just killed it. So little individual contrarian dreams happening, mixed up with follow-through stocks too, though. Like, where you think, oh, Caterpillar's opening up 10. It's not going to continue to hold those gains. Oh, yeah, it is. And we're going to tack on another 10. And you know where else I got hit yesterday? Coca-Cola, Joel. Out of nowhere. Coca-Cola. I trade Coke all the time. It usually moves 20 cents. It opens down 50 cents yesterday and then falls another 60. Falls $1. No headline. We'll just peg Coke $1. These are big moves. Like Coke usually moves 20 cents. A big move is, and on the opening bar, if you bring up Coke from yesterday, you don't even see it there. It's the little blank line there. But you can see it traded down to 70.60. And then literally half an hour later, it's back like nothing happened. Random walk is this market right now. Very random, very tricky to trade.
Yeah, Coca-Cola. Okay, wow.
We're all over the place, but
yeah, I know.
There's a point here. And the point is, the market is very random right now. Random markets are very dangerous. So
I agree.
I'm just being cautious. I've decreased my size a little bit here because when you get on the wrong side of something like ServiceNow, look at ServiceNow, down $35. It's starting to get hit a little bit last night, 922, 921, 920. And I'm like, there's definitely somebody who knows something here, and now all of a sudden it's down $35. So, I mean, there is big, news? Violent moves. I don't even know. I didn't look up the headline. I'm sure there's news. Stocks don't usually just fall $35 out of nowhere. No. The DOJ launched an investigation into SAP? Yeah, for SAP, and that stock has involvement with now in major government contracts. So you got to really read stuff.
Oh my gosh!
I mean, the SAP news is hitting NOW. So I mean, it's all just tricky. Trying to figure out. Everybody, you got to know the love triangles of all this stuff. That ban DOJ, SAP, and SAP's down 5%. You got to know. Well, that's going to hit now as well. So there was a lot of crazy moves, Joel. That's a big move too. When you see ServiceNow down 4% on it, they're not even getting investigated.
Wow. Let me reset here because you covered so many stocks.
Power hour. What we do?
Okay. Technically, I did see something in Amgen here, and I don't know where it's going. I don't know about support. I don't know. I just know there's a wall here at 339. There's 4 daily highs right at this area. So I don't know about 324 or 304 or the pre-market low. I know that's a major resistance there, and if it can't clear that in the next couple days, I would look for some downside there. That's the only good number that I can give you in this. Regeneron, I mean, the only number, I'll give you the number Dennis gave me, and he said it turned at 1,100. There was a big seller there. It went bid, and then the guy, you said he wouldn't move at 1,100, right? So
he decided he's going to iceberg it up there.
He iceberged it up there.
Yeah, okay, he got hit by the iceberg.
Besides that, man, I don't know. It got whooped 2 days in a row, and then people are probably short scrambling in that one. ARGX, that looks like the tame one of the group here. As long as it holds 540 on the upside, it looks like it's oh wow, it's up $25. I don't know if you had a target at 544.75. Well, you got a shot at it right now. And Dennis, I know the oil just got hit and it kind of bounced back. But the S&Ps are we are not moved. We are stuck. We're stuck. We're stuck.
The S&Ps just fine. If they're going to hit something, they buy something else. The whole point, the algos are all written just to basically hold everything steady. So, we're going to hit Microsoft. Well, then we're going to buy Apple. Or we're going to hit NVIDIA, then we're going to go buy Tesla. I mean, there's just crap like that happening. The ETFs have kind of ruined the market. It's just all ETF effects on everything. And if you don't understand ETF effects, we've done seminars on it. We talk about it. We're going to teach it further because it's basically all that matters. If you don't understand the ETF effects, they affect the stocks more than anything. And I've talked about on the Qs relentlessly here, where you get, too big of a move in Meta, so they automatically have to go buy Kraft Heinz because of the ETF effects. The ETF effects on this market are extraordinary. There's more ETFs, I think, than there is stocks. So you've got to consider that. What we've done is just by letting so many ETFs keep coming here, the stocks are losing their connection to their own fundamentals. It's all that matters is ETFs now. They should pull this segment and post this because it's the truth.
All right, I'm just going through my pre-market movie here, some other stocks. There's one stock that I guess it reported earnings, but it was over $100 at one point during the crazy COVID markets in 2021, is now below $3. And I think it's kind of the writing on the wall for this whole, I'm not going to say industry, but grouping of stocks, if you will. That is Stitch Fix. Ticker
Oh yeah.
SFIX. The earnings report was not great, and basically, I'll give the numbers if we actually care about the specific earnings. So, a loss of 29 cents, missed the estimates of a loss of 19 cents. Sales came in at 319.6 million. Beat the 318.5 million. The revenue guidance was a little bit light. But basically, this whole grouping of companies that run this subscription-based box model, you have BarkBox, you have Stitch Fix, you have some that aren't publicly traded, like, HelloFresh and some of these others. I just don't think any of these businesses really make money or are that profitable. And I don't think there are any that have done that well on the market. I think Rent the Run.
Sorry, and they don't have any path to profitability here. When stocks go from $113 back in 2020 to $3 and now $2, they usually, eventually, sorry, longs, continue their path to zero. That's what usually happens. I'm not saying this is going to be the one. This may be the one. Maybe this is the Amazon that goes down 95%, it comes back and goes all the way up. I'm betting it's not.
Yeah.
I'm betting Stitch Fix is not Amazon. So your Beyond Meats, obviously we saw Bed Bath and Beyonds and all these other things. I mean, Big Lots. I mean, these stocks, when a stock loses 90% of its value from its all-time high, the company has serious, serious, serious problems. And a lot of times those serious problems eventually equal bankruptcy. Rule of thumb for me, never buy a stock in your long-term portfolio that's 90% off the all-time high. So as soon as you see, just do the math, they go down 90%, they very seldom come back.
Rent the Runway is another one that's publicly traded that's on a similar subscription base model there. That actually that one's held up a little bit better than the rest. Ticker
What's
Rent.
it? Oh, RENT.
Yep.
I was trying to think of like
actually never mind. That's down a lot too. I guess they did like a reverse split or something.
Oh,
I saw it was still up at $10. I was like, oh, that's holding up, and then it was like, oh no, it was at a high of 350. Sorry, Joel, what were you gonna say?
I was trying to come up with a good pun here for Stitch Fix, and need some mending or something like that. But I don't know. Is this a new all-time low here? Boom, boom, boom. I guess it's not an all-time low. The monthly low at 249. You haven't seen that yet, and the all-time low is 2.06 there for Stitch Fix. I guess people are going to stores to buy their clothes and don't need people to send them to them online.
Yeah, Dennis, and back to your point about stocks that draw down that much that typically they don't come back. And I know there are always exceptions, but like take something like the 2021 markets, where specifically with these kind of, let's just say, not great companies or companies that without great balance sheets or that weren't that profitable, that you had run up into these crazy highs. I mean, you look at Upstart, how it was at like 400, whatever it was.
What do they do?
Upstart does personal loans. Would you almost give an exemption to that whole grouping of stocks just because they got so, crazily overvalued and the stock prices went so high that it's like, okay, that it wasn't, Upstart would have never gotten that high without these like market conditions that we had in 2021.
No, I give no exemption. $400 to $37. The stock still, you bought at $400 at $300. You're still significantly off. Does that mean it can't have rallies? Does that mean you can't play it from the long side? Does that mean there can't be turnaround stories? I bought Unity. I mean, there can be reasons, and there can be so there's always nothing's 100%. If everything worked 100% of the time, I would have been retired when I was 19 years old. So nothing works 100% of the time. But what we're saying is the majority of the time, these stocks don't come back. So all the crypto stuff, that just went down, 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 most of the stuff's not coming back. All the pot stocks, most of that stuff's not coming back. Beyond Meat, probably not coming back. Upstart, probably never going to see $400 again. Probably not. So, does that mean you can't have rallies and play this stuff from the long side? It doesn't mean you can't trade it. It typically means, I don't invest in this stuff. A firm, maybe there's a place for some of these, but I mean, a lot of times, you have stocks that go down huge, they have rallies, then they go down a bit, then they have rallies. But a lot of times these stocks continue to leak away, and just death by 1,000 cuts. So I just think it's a better, to stay away
it's
from
a general, yeah.
The human nature is to see a stock that was at 100 and say, I'm going to buy it at 2, and eventually it's going to go back to 100, and I'm going to make all this money. That's natural human nature. You have to kick that out of you. Like this, if you're going to start trading and investing, kick that out of you. It's really like to Brian Shannon. Buying strong companies. If you're a trader, it's getting with the momentum, and the momentum can turn, and you can trade some of this stuff. And sure, I'm long Unity right now, so that's a complete exception to my rule. There are exceptions in there, But again, I had a headline. Do I think Unity's going back to 200 anytime soon? No. Do I think it's got 25? Maybe. So maybe 30. I don't know, but that's a headline difference. So there's you can make exceptions to the rules, but it's just a good rule of thumb that if you're looking at stocks, and that's just how you do your scanning, what's down 95%? Well, I want to buy those ones because they're going to come back. I think you're doing it wrong.
You're a bottom feeder. No, I think my point was like I think sometimes the stocks can get into this, like they're like grouped together and they move to where, okay, so you mentioned Amazon, for example, as an exception, that Amazon did draw down 90%.
Yeah.
If Amazon would have drawn down 90% in 2012 or something, then it's like, okay, there's probably some company specific things going on here that might mean that like the company's not going to survive or not going to do well, or it's not doing well. Amazon drew down 90% in the .com bubble. There were like clear reasons why Amazon
98, I think it was.
But what my point is I don't think like if you were just looking at Amazon as a single company, there was maybe any reason for it to have gone up as high as it did or as down as low as it did.
But one thing about Amazon, which is, a little bit, like if you've been following the story for a long time, they didn't really care about it. They spent money. They didn't care about earnings. They spent money on development. They spent, they weren't trying to, pad the books. They didn't care about that. And the street just kept on like, giving them credit. Like, yeah, they're doing the right thing. They're doing the right thing. And they spent a lot of money on building companies. So that, that's an individual story.
You know what else helped Amazon? I'm just like, just analyzing from where it was. All their competition went out of business.
That's true, yeah.
Because every other online company, they were the online bookstore and the online pet store and the online this store and the online 7-Eleven, and they were all worth $1 billion because they had a website. Most of those companies went out of business because the 2002, 2001, 2002 to through 2003, it was just like, stocks dying everywhere. Bankruptcies every day. End of this company, end of this company, end of this company. NASDAQ down 81% from the highs. It was something, folks. So Amazon was like last man standing, and he had Bezos, in there, just genius, and just capitalized on it by expanding and like going into other things. Like didn't just go with the bookstore. It started as an online bookstore, then expanding into this online, expanding into that online, expanding into that online. Just, investing in smart people. So again, that's another thing. Like once you identify somebody, and a lot of these CEOs are really smart, but once you identify somebody that knows how to execute, and it's a hard combo to be smart, but then actually execute. Those are the people you want to invest in. The people who can actually get it done, make it happen. But invest in good management teams, and you'll do well usually as well. So Bezos, unbelievable.
All right, Don, Marcus is kind of holding steady here. I see our guest joined us here early here. That's Kevin Merritt. He's a CFO, he's a managing director of equity research over at Wedbush Securities. I'm waiting for him to give me a thumbs up. Kevin, are you ready to come on yet here? And I think so. Let's roll the intro, folks. I'm really looking forward to this guest. All right, Kevin Merritt, good old director of research at Wedbush Securities. Thanks for joining us. Kevin, I think you were listening into our earlier conversations here, and I know you're a veteran of the markets here. And what any comments on just the randomness of this current random rally, continuous rally in this market?
Thanks for having me, Joel. I think the path of least resistance just remains to melt up, given the favorable trends in inflation, the friendly signals from the Fed, and the fact that in the aggregate earnings are sort of hanging in, albeit in a sort of mixed bag nature. So a lot of dispersion, which is healthy, plenty of opportunities. As the gentlemen were just pointing out, there's the likes of Stitch Fix struggling, but the likes of Microsoft continuing to do well.
Okay, so let's get to some sectors. And the sector where it's been hot. Will it continue to be hot? Let's talk AI.
I think it's going to continue to be a constructive backdrop for the companies that are clearly viewed as levered to the theme now. So Microsoft, NVIDIA in particular. But I do think there's going to be a fairly heated debate about who else benefits or loses. IT services right now is quite a mixed bag. The likes of Accenture have had some tough quarters over the past year. Infosys doing a little bit better. There's quite a bit of debate about cannibalization versus opportunity set. I happen to think there's a good opportunity set medium term, but that's a highly debated point. And then there's other areas of software. Companies like Palantir are doing quite well. They're early in demonstrating ROI on use cases, whereas others, I'd say, are getting their solutions more finely polished and need time.
Why do you think Accenture has kind of struggled in this backdrop? Because you would think like one of the world's biggest, tech consulting firm would be, getting a lot of business right now by companies that want to implement AI, strategies in their businesses.
And I think medium term, that'll prove to be the case. Near term, I think it's been two things. One, they overhired during COVID, and there's still a hangover effect from that. And secondly, there's certain portions of their portfolio that are more cyclical in nature, the end markets, and those have remained weak. So they've stuck in a bit of a position with too many folks, and it's muddying the growth waters.
But if long term, Accenture does benefit from companies moving, start from companies implementing AI solutions, like it could be. Do you think it could be a good entry point here for Accenture?
I do. I think it could be a really good medium-term entry point because they've had some struggles. It's more controversial at the moment, and I think we'll look back in a few years, and this wave will be akin to the ERP wave or the SaaS applications wave, where there was a tremendous demand from customers for assistance from the likes of Accenture.
What about, this is AI related and something we've seen, no pun intended, heat up in the past just like week or so, but some of these nuclear stocks and nuclear companies, have you been watching that sector, any of those stocks?
It's not an area we cover. It is something I'm watching, and I do think it is logical directionally.
Okay.
Kevin, what could go wrong in this market?
Yeah.
What could go wrong?
Two things in the aggregate. I think the earnings picture could be disappointing. We're arguably seeing a low end recession already. You look at the results from the likes of the Dollar Tree, Dollar General, some certain credit metrics and subprime categories. There's clearly stress in the bottom quintiles of income. To the extent that grows, that could be a problem. More specific to AI, I think the biggest thing is like an expectations gap around. Clearly, some things are ready to roll, chips, Microsoft solutions, etc. But broader applications are still being built, refined, toyed with, and so you could have a little bit of a valley to get through where stuff is not quite ready for prime time.
We were talking biotechs here earlier, and just there's some really crazy moves off the news, and then you put in your notes that ARGX, who was part of this news, trading up $25 at an all-time high here. Could you give us some general comments on ARGX?
So I think the backdrop is improving for the sector, given the direction of rates, the fact that we've digested now over 2-3 years a bit of a valuation disconnect. You're seeing a little bit of an improvement in approval trends slowly, whereas there had been a logjam. And specific to Argenx, they've got a leading product for MG, myasthenia gravis, and they've got a number of other products that are reading out in the pipeline. And so I think the move in the stock is reflective of improving sentiment to the sector, and then also improving optimism around some of their incremental solutions. And maybe lastly, they are, I'd say, a marquee target for large M&A by one of the really big pharma companies.
Let's move on. You mentioned, at least in some sectors of the population, recession R word, we don't hear that much. But you Wingstop, WING is a stock that you cover. To get
Yes.
General comments on the restaurant sector or wing. I've never had their wings. Are they good? Is the food good there? I've never had their food.
I've actually never had their wings either. There's only one that recently opened in my area, but I think that's actually part of the growth story, that people apparently love their wings, and they've got quite a bit of runway in terms of the opportunity to open up new stores, expand the geographies. The restaurant space has seen pretty mixed results recently. There has been degradation in transactions and pricing trends, and so Wingstop is definitely an outlier. And that they're comping in the 20s, they're opening a ton of new stores, they're seeing nice margin tailwinds, and the stock has done well, but it's one that we still really like quite a bit.
All right, sorry, go ahead, Joel.
I just want to talk financials here for a second.
Sure.
We had the banking crisis, right? A year and a half ago here. Do you have some general comments here? I know Warren's been selling. He sold some more Bank of America here. You have some general comments on the financials, and do you have any individual issues you're keeping an eye on?
Yes. So we have been quite cautious on the regional and mid-cap bank group for the past couple of years. And we've just recently, in the past few months, turned to a more balanced, neutral sector view. And the thought being that to the extent that the economy is able to hang in there and credit metrics don't exhibit too much deterioration, and you see rates move in a more favorable direction, that at least it's appropriate to have a more balanced stance. Yesterday, our analyst actually just upgraded a number of stocks and put one on our best ideas list, Western Alliance, WAL. That's one that did have some dicey moments in the March-April timeframe of 2023, but we think is in a healthy financial position, and the fundamentals are starting to inflect quite positively. So that's one in particular that we like.
Yeah, there's a whole grouping of those regional banks that got crushed during that crisis after Silicon Valley Bank and Signature Bank a year and a half ago. And most of them have come back pretty well. And now you have to imagine with interest rates lowering, that should be somewhat favorable for that grouping of stocks. Are there any other regional banks outside of Western Alliance that got highlighted by the analysts?
Comerica in particular is another one that we highlighted yesterday. We did kind of a deep dive analysis on the asset and liability sensitivity of each of these banks and which sides they're heavier on. And that given what's going on with rates, that was a big input into those that we're currently favoring.
Got it.
All right, let's just move on here. Sticking with the consumer here, talk about some stocks in that sector that you're keeping an eye on.
We're closely watching the home building space. That they've had a tough couple of years in terms of the fundamentals themselves, but the movement in rates is generating quite a bit of optimism there. The home improvement space is another one where not excellent or inspiring comps the past several quarters, but potential to see improving fundamentals with a lower rate backdrop heading into next year and improving housing fundamentals. So those two segments in particular are a couple where the fundamentals have not been great recently, but we're thinking there could be prospects for improvement, at least a little bit.
What about some of these like household names that have gotten, despite the market being at all-time highs, there are some stocks out there that have just gotten beaten up. And I'm talking about really over the last, like 6 months or so, maybe a Lululemon, an Ulta Beauty, a Celsius. Like, do you see any opportunities in any of these beaten down stocks, or do you think they're getting beaten down for a reason?
Generally speaking, I think they're getting beaten down for a reason. I would add Nike and Starbucks to those categories. In the case of Starbucks, you have a new, very strong executive, but we do think that's going to be a heavy lift for him. Celsius is one that I would just say I do think there's strategic value potentially in that asset. And the stock has come down a lot.
It's a little like tease, like you're not going too far into the bull thesis, but there could be some strategic value there. I agree on Celsius specifically, just because like from my eye test, I see way more people now drinking Celsius compared to a Monster or a Red Bull. And you look at like the market cap of a Monster Energy, and you're like, there's growth potential here. Like I understand maybe the growth story hits some of these road bumps, but most of the time that happens with a company. Like there are very few companies that just grow at the same rate for, 20 years. Like there's going to be some, maybe iterations there. So Celsius is one that is definitely interesting. Like I'm not trying to catch a falling knife here, but I think, long-term could be potentially interesting.
Yeah, I would agree with that. They've significantly built their market share in the last few years. To your point, you can't grow 100+% forever. And so we have hit a little bit of a speed bump recently, but it's a good category. They are a leader. Whether it's Pepsi or others, I do think there could be strategic interest.
Kevin, before we let you go, just want to talk the Fed, the path of interest rates here. The Fed cutting while the market's at all-time highs, heading into an election. We've been all over the map with the amount of rate cuts, where the economy's at here. Could you just give us your 6 and 12-month projections here for interest rates?
I think the market is about correct, that you'll see, somewhere in the range of 150 basis points in the next 15 or so months, and you'll get down towards what they've indicated in the dot plot, around 3% by the end of 26. That feels logical to me. So unlike other points in the past, Joel, when we've spoken, I felt the market was significantly mispriced with its rate cut expectations. I think it feels about correct right now, in absent a big positive surprise in inflation, which would be obviously problematic.
All right, we've been on the line with Kevin Merritt. He's a CFA. He's managing director of research at Wedbush Securities.
Wait, I got one more question for
you.
Kevin.
You got one more? Go ahead. Yeah. Throw him a curveball.
Well, how'd you know, Joel? How'd you know I was going with a curveball? So let's talk some sports here, Kevin. Do you have an NFL team? Do you have a baseball team you're rooting for into the playoffs? And then the second part of that question, will tie it into the markets. What do you think about just the, investment opportunities in some of the, your DraftKings or Flutters of the world?
I'm a big Red Sox fan. It's barring a quick change here, it's not looking like it's going to happen for us playoff-wise this year, but it was still a respectable season. I'm a big Patriots fan. I think we're still a bit in rebuild mode, but I watch a lot of both baseball and football, irrespective of how my favorites are doing. And we don't cover DraftKings, but I do. Clearly, there's an avalanche of activity in this space that they're positioned to grab a decent share of. I guess from afar, my only negative observation would be I think they're still trying to figure out the business model and the ROI. But gun to the head, they'll probably figure it out.
Kevin, I got now he got me going. I got one more for you from our previous chats. You have really interesting background on Wall Street. You've worked at different places. What would you compare this environment to in all your years working on Wall Street? What we've seen in the markets. What would be the closest comparison you have?
Late '90s excitement around a new technology and a debate around how quickly it's going to be effectively implemented and ROI generative or not. And so
fantastic.
My hope would be that this round it's more successful sooner. My fear would be you could have another valley of sorts where you have a few years of disappointment where the technologies aren't ready for prime time.
Okay. All right. Here we go. Wrapping it up with Kevin Merritt. Kevin, everyone in chat really likes your input. We'll get you on again soon. Thank you very much.
Joel. Take care.
Have a good one, Kevin. All righty, guys. That was Kevin Merritt. Clap it up for a first-time guest. Smash the like if you haven't already. Chatty.
What's going on with DraftKings? They get an upgrade or something?
I don't know. They should be down today because I hit some big bets on there last night.
It's up $1.86. Let me see if I got any
Flutter.
Okay.
Flutter, of course, the parent company of FanDuel now. What did we get?
Sees profits doubling by 2027. Authorized a $5 billion share buyback. That'll do it. No messing around. They don't want to confuse the algos with some wishy-washy talk. So we're just like, here we go. Algos, this one's for you. We see profits double in 2027 at $5 billion buyback. The algo's like, buy. Damn, DraftKings, buy. That's what it does.
Dennis, we had that one.
So if you're a corporate executive, or you're, part of the finance team, you're trying to get out there, don't confuse the algos. Come out bullish or bearish because the algos are too stupid to interpret it. If it's not the headline, they don't care.
I will say, it just, again, this is just anecdotal. Like eye test, same thing with me seeing Celsius, people drinking more Celsius than anything else. Like the amount of just the volume of people that I see on DraftKings, on FanDuel now is insane. Like I was at a restaurant, a bar for the Monday night football game. There were actually 2 Monday night games. And I walked to the bathroom at one point and I passed by like 6 tables, and every single table, someone had their phone out and was like showing someone else at the table their bets or what they needed on the game. I was like, it's like becoming ubiquitous almost at this point that everyone that's like watching a game has some action on it on their FanDuel or on their DraftKings. I don't necessarily think it's a great thing, but it seems like the businesses at least, are doing well right now, at least in terms of attracting customers. Again, like long term, I think there'll be, Penn is the exception to that rule because Penn is more, in-person casinos,
it's
the horse tracks.
Now.
Horse
for a while there, we thought it was going to be the sports betting play, but it turned into a casino. So, it's DraftKings.
Well, it's the horse racing. Besides the Triple Crown, there's it's big a horse racing fan as I am. It's my dad told me in the mid 80s it's a dying sport. But anyways, we got some analyst action today here, and we only got 11 minutes left. So AB, lead us the way here with the analyst action.
Let's go with GM first. So we have GM, which had an analyst rating the other day. They're ganging up on GM here. Joel, we got to stand up for our Detroit companies here. So Morgan Stanley downgraded the stock from 47 to 42. Was this Adam Jonas? Because he's usually pretty bullish on. Yeah, it was Adam Jonas.
He loves Tesla and hates all the other autos. See, Adam Jonas is my man. he listens to PreMarket Prep, or maybe I listen to Adam Jonas. We got the same opinion.
Yeah, and
all the other autos are value traps and Tesla. That's where I'm at.
To his credit, which we don't see analysts really going against each other all that often on the street anymore, but to Adam Jonas's credit, during the Big 3 strike, what was that, about like a year and a half ago, where all three major autos in Detroit were striking at the same time. You turned on CNBC and some guests were saying, oh, if you know, this could put these companies out of business, this and that. And then Adam Jonas was coming out and saying like, no, GM's a buy, Ford's a buy, you know, all these companies are buys on this dip during the strikes. And he ended up being right about it, at least more so on GM than the other stocks. But now he's coming back and saying that they're moving it from equal weight to underweight and moving the price target again from 47 to 42. So GM down about 3.5% on that.
They're ganging up on it. This caught a downgrade yesterday, was able to shrug it off, but the old double downgrade here are back-to-back days. This is a big hit for GM, down $1.71. So anyone that bought the dip yesterday, they are underwater today. Now 47, I would have said, hey, that's support. Now I'm going to call it resistance. That's not even near yesterday's range. So this is a big turn here. No two lows in one area. So if you're looking to pick a bottom here, the next day, man, and probably already saw this, 46.12, 46.20 is your pre-market low. Maybe there's some fat bids sitting there at 46, looking to bring in a short-term position, but man, not Jonas knocking it down. Ford started to turn anyways here. That's just kind of quiet. That's not down 25 cents. Stellantis, which has been in the gutter too here. Let's take a look at that. Stellantis, that's not down, but that's already been hit. Trying to build the base here at 15 in
Stellantis dividend 10.77%. I don't know if they've cut that, if that's old, but I'm still seeing a 10. Is that still a current yield? 10.77. I mean, when you see your dividends going like 8, 9, 10%, it's a good bet that dividend may not be safe. I mean, Stellantis has been a mess. You'd think with interest rates going down that it's going to be good for the car companies. So I'm a little bit, you know, that the timing of the note is interesting considering we just got a 50 basis point cut. We're into a Fed lowering rate cycle here. That's the one thing, you know, that should be good for autos. So I don't know if I'm super bearish all the autos here imminently here. Longer term, if you got a 4 or 5 year time horizon here, everybody else is going to say you can't go wrong with GM. I'm going to say you can go totally wrong. Brother-in-law was saying, oh, yeah, Ford, how do you go wrong with this one? I was like, you know how they go wrong with this one? Is if FSD actually comes to fruition. And again, it's a big if. You know, we know Waymo's got it, but Waymo isn't a direct competitor to Ford, but Tesla sure as hell is. And if you got, you know, all of a sudden the cars are driving themselves, be like, well, what about you, Ford? You know, I'm going to buy my F-150. Does it drive itself? Oh, well, we're looking into that. They're just not. You know, that's the issue that I have with all the auto companies is that if FSD really does come to fruition, it's a big F. If it doesn't, Tesla's going to be a sell, and Ford and GM of those maybe are going to be buys. But if Musk figures it out, it's real bad news for Ford. At least GM's got Cruise working on the bet. But they're so far behind on all this stuff because you can say, oh, well, wait, though, Dennis. Waymo's already operational. Cruise is working with them. They're already operational. But they're not going to just all of a sudden be able to put it on every car. You know, you're not going to buy a $200,000 car.
Yeah, expensive.
So if Tesla can figure it out and put it on a $30,000 car, that changes everything. That's why I just cannot be long Ford, GM, Stellantis, none of them, because I think Musk figures it out.
Okay, some other analyst ratings, some stocks. We've got DoorDash. You had KeyBank come out and initiate coverage on DoorDash with an overweight rating, a price target of $177 a share. Wow. DoorDash currently at $145 a share. So that's a nice $32 premium from there. Some quick math tells me that's about, we'll call it 20, we'll call about 20% from there. DoorDash up about 2.3%, $3 on the rating there from KeyBank.
Moving up. It's breaking out. It looks good on the charts here. Delivery services, people are lazy, you know, and you get your food delivered. It's working here. They are. That's a lazy world.
It's
expensive.
Expensive.
It's really ridiculously expensive, but people are paying it. There's got to be some good markups there too. I think Tesla's going to come in this pool eventually too, but it's a long ways out. So I'm not putting Dash in my long-term portfolio, but from a trading perspective, it's moving.
Finally, trying to get back half of that move. I mean, from that all-time high that we made when everyone was getting deliveries, 257 and a quarter, all the way down to 40.77, halfway back. Let's just eyeball it, the 149, 150 area. Breaking out on the monthlies too. So if you're looking at this from a monthly perspective, you got to make a bid above 143. So making a move on an analyst move. If you had a target in this area, perhaps see if you could get a run up here to 149. That's just about the 50% retracement.
I do think if there is some sort of, widespread consumer pulling back, saving money, I feel like food delivery has to be the first thing to go because like you guys said, it's so expensive. Like if someone is door dashing, 2 or 3 times a week, they're spending $150 on that for 3 meals. That could easily be $50 for those same 3 meals. So again, like if I start seeing that the earnings start decreasing for these companies and it's all on this backdrop of people are cutting back, I would expect like all these food delivery things to really start not doing as well. But we haven't seen that yet, which tells me that the consumer is still like strong and willing to spend money.
This was a conversation for a year ago, though. We're not in that environment anymore. We're in a rate cutting cycle. If the consumer wasn't cutting back a year ago, why are they cutting back when rates are going down? They're going to have more money.
Spend more money.
That's why it's hard to be bearish stocks here. It's hard to just come in and say, this is it. The recession is here and stocks are inevitably going down. I don't get it. I don't get that conversation now. That was a conversation for a couple of years ago. That was a conversation for 2021. And you know what? You killed it. If you shorted everything at the peaks in 2021, took 2 years for the markets to get it back. IWM never came back at all. I mean, that was the time to be all bearish. The only argument for the bears here right now is valuation. And valuation is not attractive on a lot of stocks. On the good ones, we know the valuation's high. And on the dogs, the valuation's low for a reason. Same as our guest just said. A lot of these stocks are getting hit for a reason. But when you just take it and look and say, hey, I don't get how we're going to go into a recession when we all of a sudden are dropping 50, maybe another 50 next month or another 25. I mean, what's causing the recession? If we go into World War, talking about all that, that's always bullish too. So it's hard to be bearish stocks here. If I was bearish stocks, I would not have a Tesla position like I have it. I think interest rates are going to help Tesla. Again, I know we talk Tesla a lot, but it's been working, but other stocks too. I mean, there's just, it's just not the time, I think, to be bearish stocks.
Not when the Fed's cutting rates at all-time highs. I mean, that's just
they're cutting rates at all-time highs.
That's just a scenario.
And you can look, and Jim Tassoni, fantastic. Obviously, we love Jim. He gave a really good presentation last week. But on the history of those 50 basis point rate cuts, we were in the we were in the gutter in the economy. Like we were in full recessions. Global financial crisis. Tech. Bubble burst. There's different reasons for cutting rates. COVID crisis. There's no crisis right now, and they're cutting by 50. How is that bad for stocks? Hard to be bearish.
No, not bad at all. I think my point was if I start seeing that the earnings are decreasing for DoorDash, that could maybe give me some signs that, okay, now finally the consumer is starting to save some money. You have certain things you look at credit cards and stuff like that. It seems like people have kind of just kicked the can down the road where people are still spending like they were, even with less in savings. So eventually, if you think okay, people are going to have to start cutting back and start paying off those credit cards or other debts. But right now, your point is that's not happening right now. So we can't trade like that's happening, but it could happen eventually. And I think that the food delivery names are ones that we could see that weakness in first and foremost, just because I think as people are trying to, it's like that and vacations. Like Dennis, if you were trying to cut back for your family and you're like, okay, well, maybe that's an easy thing. We won't go to Disney World this year because that's, going to save us a few $1,000s right now. And I don't think you do order food, but say you did get food delivered 2-3 times a week, that'd be an easy spot to cut back on too. So I think eventually that could give us some signs to whenever the consumer is starting.
Again, we're going full circle here because I just think this conversation was a year ago. But your opinion, AB, is very valid because your opinion is what I'm hearing on CNBC all the time. I'm hearing it on Twitter. The recession is coming. The recession is coming. The recession kind of came. It's in Canada right now. We're coming out of recession in Canada. I think we're going to come out of recession. We're still full on in a recession in Canada. The reason the US didn't go into recession is because all the regional banks helped out everyone by having 30-year fixed mortgages where you had your interest rates locked up so that the interest rate hikes really didn't hit the little guy that hard because they were already locked in on their mortgages. It hit everybody in Canada, hit everybody everywhere else in the world because nobody else, other banks are stupid enough to loan money for 30 years at 2%. But they were. And we saw, obviously, Silicon Bank and a few of them went down because of this. So, I mean, we're at a point now where it's completely different. I think if we're starting to get bearish here now, again, we're at all-time highs. Any crisis can happen. This is why I continue to listen to the show, because somebody will tape this. We'll have some epic crisis come in. And then they'll say, well, Dennis, you were bullish, 3 months ago. And, we're holding you to that. You're an idiot. It's continuous information. With the information that I have today at this moment in time, I don't see an imminent recession coming. I don't see oh my gosh, rates are going lower. We better not spend any money. Interest rates going lower are a stimulant.
Good. Yep.
Stimulant. Last time I looked up at my CFA books.
We're up on time here. I guess I just want to clear up. My point of view is I'm not saying I think there is.
I'm not attacking you, AB. I'm attacking the point because
the
your point is a valid point. Your point is I hear it everywhere. Everywhere. It's wrong.
No, I know, but my point was not that I think we're seeing this slowdown and you're going to see it in these food stocks first. I'm saying I think if there is a pullback, which there's not right now in spending, that these would be names that you'd see it in first. Not that it's
for sure.
Here right now.
We're not at that.
Or coming. Right.
That's why Dash went down 2 years ago with that conversation.
But
that's why Dash
it never happened.
$150 to $50 because interest rates were going up and a lot of people maybe were cutting back to a certain extent. We had a recession.
All right. Well, that brings us to 9:02 a.m. A couple of minutes long here. Great first time guest today that we had for Kevin. Joel, who do we have coming on with us tomorrow?
We're going to talk. Well, it's great. We're going to pick up right where we left off tomorrow. We're going to have Ryan Craver on from Commerce Canal, and he does just top-down analysis of the retail sector. So that will be our guest tomorrow, closing out here. That all-time closing high for the S&Ps, not for everything, is from yesterday at 57.92, and then that high from last week is at 97.50. So, man, the bulls, you got a target there. Get it saying the 5,800 handle, and away we go. But great informative show today. Thanks to the chat. We'll be back with you tomorrow.